When most people think about the UK property market, they think about London prices, London growth, London rents, London headlines. But what if London isn't actually the most important story anymore? What if real opportunities are hiding elsewhere? Today we're analysing millions of UK property transactions to uncover where the market is actually active, not where journalists talk about, not where estate agents market, but where buyers and sellers are genuinely transacting. Using two advanced visualisations, we'll uncover which areas dominate the market, which regions quietly punch above their weight, and which locations deserve far more attention from investors. So let's dive in. This first chart plots two very important metrics: average property price on the horizontal axis, transaction volume on the vertical axis, and each bubble represents a district. The further the right a district sits, the more expensive it is. The higher it sits, the more transactions occur. This allows us to identify areas that combine both activity and affordability. Immediately one area jumps off the screen: Birmingham. Alongside Leeds, both districts generate enormous transaction volumes, yet neither sits among the UK's most expensive markets. That combination is incredibly important. High liquidity, strong demand, relatively affordable entry points. These are characteristics that many investors actively seek. Now compare that with somewhere like Buckinghamshire. Average prices are significantly higher, yet transaction volumes are much lower. That doesn't mean it's a bad market, it simply means it's a different market. Higher value, lower turnover, different investor profile. Then we have County Durham, one of the most affordable areas on the chart, yet transaction activity remains surprisingly strong. This highlights something many investors overlook: affordable doesn't actually mean weak demand. In fact, some lower priced areas generate remarkable levels of activity. What's fascinating is that many of the districts clustered in the centre of the chart sit within what I call the investor sweet spot. Not ultra cheap, not ultra expensive, but locations where transaction volumes remain healthy and average prices remain attainable. These markets often provide the strongest balance between affordability, liquidity, and long-term demand. And this is exactly why looking beyond averages matters. National house prices tell us very little, but transaction density reveals where people are actually buying and selling. But individual districts only tell part of the story. To understand the biggest picture, we need to zoom out, and that's where our second visualization becomes very powerful. This visualization groups districts into larger regional clusters. The size of each circle represents transaction activity. The larger the circle, the greater the market presence, and surprisingly Greater London dominates. It's impossible to ignore. The largest circle on the entire chart, the highest concentration of value, the highest concentration of capital, and one of the most influential housing markets in the country. But here's the interesting part. Once you move beyond London, a different story emerges. Look at the South East cluster: Surrey, Kent, Hampshire, Essex, Hertfordshire. Collectively, these are an enormous property ecosystem. While they don't individually match London, together they represent a substantial portion of the UK market. And then we see another fascinating cluster: Greater Manchester, Lancashire, Merseyside, northern regions with significant transaction activity. These markets often receive less media attention than London and the South East, yet they continue generating huge numbers of transactions. And notice how some regions punch above their weight: Oxfordshire, Buckinghamshire, Gloucestershire. They don't dominate in volume, but they command significant value. These are often areas where pricing power remains exceptionally strong. One of the biggest insights from the visualization is that UK property market isn't a single market at all. It's a network of interconnected regional markets, each with its own dynamics, its own affordability profile, its own growth drivers, and its own investment opportunities. So the big lesson is that when investors focus solely on London, they risk missing the broader picture, because transaction activity is spread across the country. Opportunity is spread across the country, and demand is also spread across the country. The data shows that some of the most active markets are not necessarily the most expensive, and some of the most expensive markets are not necessarily the most active. Understanding that distinction is crucial. What this means for investors is that if you're searching for cash flow, you might focus on high volume, affordable regions. If you're targeting long-term capital appreciation, you might lean toward higher value areas. If you're looking for liquidity, you'll likely want markets with stronger transaction volumes. The key point is this: different locations serve different investment strategies, and the best opportunities often appear when you stop looking at the UK as one giant housing market. Today's data reveals something many investors never fully appreciate. The UK property market has multiple centres of gravity. London remains powerful, but it's far from the whole story. From Birmingham to Leeds and Kent to Essex, from Manchester to Surrey, property activity is happening across the country. and understanding where that activity is concentrated can give investors a major advantage. If you enjoy the analysis, please subscribe to the channel, and in the next video we'll show you the actual flow of property transactions and uncover where money is really moving within the UK housing market.